Hi there. Welcome to The Close. I'm Lindsay Biscaya. Markets will be closing in half an hour from now. So first, let's get to some of the other stories we're following in the BNN Bloomberg newsroom. Silver recovered some losses after its biggest one-day drop in more than 5 years. The metal climbed above $74 an ounce today after a 9% slide in the previous session. Gold also edged up after its steepest drop in 2 months. Now, despite the pullback, gold and silver remain on track for their best annual performances since 1979. Reuters is reporting that China is requiring chip makers to use at least 50% domestically made equipment for adding new capacity. Now, the rule is publicly documented, but it's not publicly documented, rather. But according to people familiar with the matter, chip makers have been informed by authorities that they must prove their procurement through tenders. The requirements are relaxed for advanced chip production lines where domestically developed equipment is not fully available yet. And we're watching shares of Tesla today in a rare move. The car maker has published an average of analyst estimates for vehicle deliveries to its website. By Tesla's count, analysts on average expect a 15% drop from last year in car deliveries in the fourth quarter. The car maker is on course for its second consecutive decline in annual vehicle sales. And shares of Meta are rising today. The tech conglomerate has agreed to buy Manus in a deal valued at $2 billion US. Manus is a popular Singapore-based artificial intelligence agent founded in China. The transaction marks a rare US acquisition of an Asian tech company. A Meta spokesperson has said there will be no continuing Chinese ownership interests, and Manus AI will discontinue its services and operations in China. And taking a look at the markets this afternoon, the TSX has rebounded from a bit of a loss yesterday. We've seen gold and silver prices also rebounding today, which is helping to push the TSX up. If we take a look at markets south of the border, relatively flat today. Now, there was some consensus that there will be rate cuts in the new year by the Fed. That came out earlier this afternoon, but it seems as though investors relatively unbothered by this news. The S&P 500, Dow Jones Industrial, and NASDAQ basically unchanged at the moment. Precious metals are recovering today after a plunge yesterday. Is today's recovery a result of investors buying yesterday's dip? For more on this is Martin Pelletier, Senior Portfolio Manager at Trivest Wealth Counsel, Wellington Altus Private Counsel. It's good to have you join us this afternoon, sir. Thanks for taking the time.
You betcha.
So yesterday we saw that drop. Was this, do you think, a profit-taking moment for a lot of investors?
Absolutely. The trade got ahead of itself. It's a healthy pullback, possibly a buying opportunity. We'll see. There was a margin adjustment made on Friday, and that shook out some of the longs, that levered longs, for example. But we don't see it being the same situation that has played out in 2011. The amount of leverage in the market back then was 25 times, and the margin requirements got pushed up to bring leverage down to 10 times. And for perspective, we're closer to 6 times. So there's lots of room there for further appreciation, despite the strong gains that we've had this year.
Lots of room for further appreciation. So do you expect to see some of these runs that we saw this year maybe continue into 2026?
Yeah. On the positive, you have China with export restrictions taking effect in the beginning of January. You have the forward curve and steep backwardation, which is very supportive for the outlook. There could be some profit taking for tax purposes in the beginning of the year as people defer taking some of the gains, so they don't have to pay tax this year, and they can defer it for next year. So there could be some volatility here, but everything's looking to line up for some continued strength in silver market and gold markets, especially with you looking at gold and tying it into other commodities like silver, palladium, and platinum. They'll all be tied to the currency debasement trade with Fed lowering interest rates, Trump tariffs, and benefiting from that, which is not expected to wane anytime soon.
I want to talk a little bit more about silver in a moment because it's such an incredible run this year. But just on that last point, we see people often switch to some precious metals when they're worried about the economy, worried about maybe their own currency. Why is that?
Well, you can't print more of it. The U.S. government and the Federal Reserve has done a really good job of printing a lot of money, especially in this post-COVID world. If you look at the value of your currency, what you were able to buy compared to 2019, you're 74 cents in the dollar. So if you look at housing market in the U.S., in order to go back to 2019 housing prices, either the housing prices have to fall 40% or your incomes need to go up 60%, neither of which is likely going to happen. And so investors are looking at their portfolios and looking at their spending and saying, wow, I mean, we're all of these dollars that are being printed to finance big deficit spending globally, not just in the U.S., it's also happening in Canada and Europe. Maybe I need to hedge against that, having some commodities and things that you can't print like gold and silver.
Okay, so going back to silver then, because you did mention, there's room maybe for more of a run in the new year for both gold and silver. Do you expect to see silver maybe continue to outpace gold? Because silver is interesting where it doesn't seem to get talked about as much as gold, but it seems like it's used for more things in an industrial sense.
Yeah, it is, especially looking at solar applications. So it has more of a fundamental use than a gold, for example. And so if you look at the surge in renewables, the growth in energy demand to fuel AI data centers globally, the shift still towards solar and its demand and implications for silver, it creates more of a levered gold trade. So you'll see silver, if gold moves up, typically will trade at a higher move up than gold and vice versa as well. So if you want to play levered gold, just own silver.
Okay, so you say that there are 3 pressure points for Canadians in the new year, just looking ahead to 2026. Of course, do you want to go over what those 3 kind of pressure points or challenges are?
Yeah, Alberta, BC, and Ontario are the biggest ones. British Columbia, you've got some serious issues in regards to having to have free, prior, and informed consent from First Nations. The government is implemented the UN DRIP into their legal force, and so billions of resource projects are at risks, and also concerns spilling into private land rights, and so capital is going to be somewhat limited until that mess gets sorted out. In Alberta, you have an autonomy push. You have a panel that's recommending a 2026 referendum on exiting the CPP and setting up an Alberta pension plan. That could lead to a full-fledged separation talk if signatures are 180,000 signatures, I believe. So that could create some instability there. And finally, in Ontario, you've got tariffs. They're probably the most impacted province from tariffs. And also housing. Housing is not a very good situation in Ontario. You've got the lowest housing starts since 2009. The 20% drop from last year. Unsold condos are at 60 months of supply. Normally you're at 12 months. And then housing prices are only down 6%, but you've got listings at the highest level in 15 years. So you tie in all of those factors, you've got an issue building up in regards to the Canadian economy, and that's going to make it very difficult for the Bank of Canada and the Prime Minister Carney.
No doubt, a lot of challenges ahead. Okay, that's all the time we have, but I appreciate you taking the time. Thanks so much, and Happy New Year.
Happy New Year.
That was Martin Pelletier, Senior Portfolio Manager at Trivest Wealth Counsel, Wellington Altus Private Counsel. When we come back, we will explore AI predictions for 2026, from autonomous vehicles to podcasts and also home robots. Stay with us. We are diving into the biggest tech trends that could shape 2026, from autonomous vehicles and home robots to the rise of podcasts in your living room. And to break it all down, we were joined earlier by Jim Anderson, CEO of Beacon Software.
We're seeing Waymo specifically going to new markets. They're in Atlanta, Houston, I believe, Dallas. There are other markets that they've announced. And so we're starting to see the issues, both the benefits and the problems associated with scale. They got a lot of press for the blackout in San Francisco that happened a week or two back. And a whole bunch of Waymos got confused. And it's one thing to have one Waymo that's confused with 1 or 2 occupants in it. It's quite another to have 100 Waymos confused and not know what to do when the traffic lights are out. And that highlights a real challenge with these autonomous vehicles, is that they all have a telepresence component, right? There's some place they call into, and there's humans that intervene. We don't know how often those humans intervene, whether they're qualified drivers, what commands they issue to the vehicles. All of that is very opaque right now. And so I think we're going to see both success and the failures and the challenges associated with that scale of autonomous vehicles.
So, but a probable slow but steady increasing of use of them, though.
Clearly, they provide a tremendous benefit. They provide tremendous potential safety improvements. We all know the challenges with human drivers, although I don't think, again, when you get 100 Waymos that are confused and don't know what to do with traffic lights that are out, is that a net safety benefit if they're all clogging the intersections? No, maybe not, right? So I think we as a society are going to have to learn to deal with these scale problems. And so that's the real issue for 26 is now it's not just a few vehicles on the roads. What happens when we have hundreds or thousands of them? What problems are we going to see? And then how do we overcome those?
All right, let's move on to home robots. We're not going to see the maid from the Jetsons, is what you're saying. And kids, look that whole thing up.
Exactly. I don't think so. I mean, home robots offer as much potential, maybe even more than autonomous vehicles. When we think about aging, our aging parents, elder care, lots of just we'd all love robots to do our chores for us. But are you going to take a 100-pound robot and put it in your home with your children when you're not sure if it's going to be flaky or how it's going to behave? There's privacy implications if that robot is in your home listening to everything that's going on in the home. There's a lot of things like that. Technology challenges, policy challenges. I am very bullish on the 5 to 10 year potential of home robots. I am less bullish on the 2026 potential for them to actually sort of be able to do anything useful in our homes.
And are they having those conversations about that, the privacy and safety too?
They are, and to their credit, I think the industry recognizes that, and there's some people inside the industry trying to tamp down expectations and say, hey, let's not get too carried away here. We've got a lot of problems to solve, technical problems, policy problems, trust issues, and really the only way to solve those is to get the robots in the homes and to start trying to experiment with them, understand in a controlled way what you're going to run across, and then try to just continue to iterate on those problems. So very bullish, 5, 10 years out, but we got a long ways to go.
Would you volunteer to take one into the home right now?
I would not right now, no.
All right, now podcasts are coming into your home. They're coming over, taking over your TV.
Yeah, even the term podcast is interesting, right? We tend to think that, remember when the podcast came out, that was the iPod and the iPod Shuffle and all those kinds of things. We tend to think of it as this audio thing. Now it's maybe more your phone. But really, so much podcast usage is happening on the biggest screen in the home, which is typically in the living room. And so even the term podcast is a bit of a misnomer. Maybe if we do this prediction next year at this time, we'll be doing it as a podcast, right? How is that different than linear TV? Many podcasts, maybe even most podcasts now have the video component with them. And if you have a video component and you're watching it in your living room, how is that really different than TV? And specifically think about late night TV, right? That's been going through quite a bit of upheaval economically and otherwise. A lot of people predict late night TV is effectively it's just going to be podcasts at this point moving forward.
Oh, I can believe that. I mean, a lot of the things I catch from Saturday Night Live, I watch as little snippets, as opposed
anyway,
to
right?
a destination
exactly.
On a Saturday night.
Yeah, that's exactly right.
And it's amazing. Technology has changed so much that it allows pretty much anybody to have a video podcast with minimal expenses. I shouldn't be telling people that.
Exactly. Well, I'm not sure the world needs more podcasts per se, but the world does need, high quality content, and especially in an age of AI with AI slop, there's a lot of low quality content. There always has been a lot of low quality content. Now there's even more. So, how does one differentiate? How do you rise above and produce? I think there's still, humans are infinitely curious, and we want to be entertained. We want to be educated, informed. And so, somebody who's got something to say, or two people or a group of people who have something to say, it's never been cheaper or easier, to your point, to start your own video broadcast, if you will, whether you call it a podcast or not, and then whether you can find an audience for it and sustain it is obviously the question.
Okay, next up, you mentioned it, AI, and please, AI slop. Some of the stuff that's out there right now, it ruins it, because you'll watch something and you go, it's not real. And you think you're actually watching a video that you want to see that's real, and it's not real. Where are we going with AI? Where do you see it heading this year?
Well, AI is pervasive in almost everything, right? It's almost become meaningless. It's like saying, where are we going with the internet, right? The internet sort of governs, it enables almost everything we do technologically. And I think AI is rapidly on the path to doing that as well. I will say physical AI, we've been talking about robots, we've been talking about autonomous vehicles. Those are physical manifestations of AI that have a very different safety set of expectations. It's one thing for my large language model to hallucinate. It's quite another for my autonomous vehicle to hallucinate. So I think what we're going to see is, number one, AI has never been just one thing. There's machine learning, there's natural language processing, there's automated incident detection on videos. There's lots of subspecialties of AI. And so I think what we'll see in 2026 is people becoming a little bit more precise about their terminology. This is not just generic AI. It's AI doing a specific thing in a specific way, whether it be physical in an autonomous vehicle or large language models, or it's helping me process a lot of data and run my business better. I think we just need to be sharper in our language, and I think the industry will continue to evolve. And in 2026, we'll still hear plenty about AI because it's just such a broad term, but the people are going to have to be more specific about what kind of AI.
That was Jim Anderson, CEO of Beacon Software. Well, coming up, the federal government says it will be introducing regulations for stablecoins in the new year. We'll get more on the stablecoin outlook for 2026 when we come back. Earlier this month, the Bank of Canada said future stablecoin regulations must be backed by high-quality liquid assets. The governor of the Bank of Canada, Tiff Macklem, said stablecoins need to be, quote, good money, like banknotes or deposits at a bank. However, for those in the industry, many are worried that Canada is falling behind on stablecoin regulation. For more on this, we were joined by Gillian Friedman, Chief Operating Officer at Symbiotic.
If you zoom out and look just at digital asset prices, Bitcoin is doing considerably better year over year. But really, what I think we should be looking at is how the underlying technology is being adopted and used, and how it's actually adding value and creating value beyond the broader crypto ecosystem. So I would say 2025 was a bit of a breakout year for crypto, because you actually started to see adoption of this technology, and this technology being taken seriously by traditional finance and other types of fintechs that aren't necessarily crypto businesses.
What changed? What do you think changed then to see that happen?
Yeah, I think one of the major changes that you really can't look at 2025 without acknowledging the shift in the political and regulatory climate in the United States. That was a major difference in 2025, that previously the regulatory environment in the United States was bordered between ambiguous to outright hostile towards these types of businesses that are building and using cryptocurrency or on blockchains. And what changed in 2025 was really an endorsement and a willingness to create a regulatory regime that provides clarity to builders so that they have the confidence to actually invest in and build products. And the other major change, I would say, or they're related, would be the uptick of stablecoins and the use of stablecoins by businesses and retail users to move money around globally.
And now Tiff Macklem talked about stablecoins and having regulations for next year. What would you like to see? One of the things he talked about was that they need high-quality liquid assets pegged one-to-one to a central bank currency. Your thoughts on that, and what would you like to see?
Yeah, I think most would say that the requirement that the assets be pegged by one-to-one and with a high-quality liquid assets held in custody in bank accounts with financial institutions is pretty middle of the fairway of an expectation. seems to be consistent with some of the other regulatory regimes that other countries are implementing. And so overall, positive approach from the Bank of Canada, and frankly, one that would have been hard to predict at this time a year ago. There was a lot of drum beating saying that Canada's moving too slow. We need an approach with stablecoins. Look at what's happening in other jurisdictions. Stablecoins are enabling further and further U.S. dollar dominance, and Canada needs to catch up. And I would say that still is the case, that Canada needs to catch up, but the current approach seems to be setting the stage to allow that catch up to take place.
And now, you also, in that speech, you promised more innovation in 2026. What do you think we'll see when it comes to that, or what would you like to see?
Sure. So I think what we can expect to see is more of a blurring between fintechs and crypto businesses. I think you may be a user of a fintech service, whether you're a business or a retail consumer, and you're using blockchain or crypto on the back end, and that's what's operating on the back end, and you're not even aware of it. And so I think you will just see a more and more mainstreaming of this technology, and that it's being abstracted such that users don't even know that they're really using it. I also think that the regulatory clarity, specifically around stablecoins, is going to enable Canadian financial institutions to more meaningfully first test, but then adopt this new tooling where it makes sense for them. And so those are two areas that we're paying close attention to. And further, we would expect to see a discussion around what happens to the interest or the yield that is generated by the reserves that are backing those stable coins. And so that's a discussion that you're starting to see happen in the United States. It's starting to happen here as well. It hasn't really been addressed by the regulators yet, and it provides a real opportunity for Canada to differentiate itself.
Okay, we're almost out of time, but you talk about, in the report you had, that you would like to see this change from securities to a payment instrument. Why is that so important? You got about 30 seconds.
Because stablecoins are primarily used as payments, and so the regulatory framework that addresses payments would be more appropriate than a securities framework, which makes it much more onerous to freely transfer these assets globally or between different owners.
That was Gillian Friedman, Chief Operating Officer at Symbiotic. Up next, the closing bells on Bay Street and Wall Street. Stay with us. Here are the closing bells at the NASDAQ. The American Red Cross rings the closing bell, and the New York Stock Exchange. Carnegie Investment Council is ringing the bell to celebrate more than 50 years of serving investment clients while supporting the Malala Fund. You're watching The Close on BNN Bloomberg. I'm Lindsay Biscaya. Here's how we close the day on Bay and Wall Street today. On the TSX, mining and energy stocks came out on top today as we saw silver and gold rebound from a sharp drop yesterday. It did help to push the TSX, ending a little flat, though, to end the day. In the U.S., markets seemed unbothered after the Fed minutes came out earlier this afternoon, and it cemented gradual rate cuts in 2026, something that was maybe largely expected by investors, so it didn't really move things too much down south. And now to take a look at the big market movers on the TSX. Precious metals saw a rebound today, as we've been talking about. Global atomic shares rose more than 3% today before closing the day at about almost 1.4% higher. This after the company announced progress in its Niger uranium mine and says it plans to secure funding to continue expanding to meet uranium demand. On the flip side, though, Energy Fuels Incorporated dropped by more than 3%. This comes after Roth Capital says the shares are overvalued due to expectations around the company's rare earth business opportunities. So that was one of the biggest draggers on the TSX today. Aecon Group is the other big decliner on the TSX, down by about 3% to end the day, just under 3%. For more on these movers, we're going to bring in Bloomberg's equities reporter, Stephanie Hughes. Stephanie, good to see you. Thanks for joining us. So we're talking a lot about gold and silver today. Aya Gold and Silver saw a sharp reversal. Is this just tied to the broader move in the metals that we saw today?
That's exactly it, Lindsay. So that's right. Aya Gold and Silver gained by over 8% at its highest point today, marking a sharp reversal from that pullback we saw in the precious metals space just yesterday. And man, what a difference a day makes. Yesterday, traders were taking profits in an asset class that had eye-watering double-digit gains so far this year. Fast forward to today, now others are swooping in to buy the dip. So if you look at silver, that recovered most of its losses from yesterday, which was its biggest single-day decline in over 5 years. Now it's moving just over $75 an ounce. Also, supply tightness keeps it on track for a 33% monthly gain. The precious metal story for the whole year has obviously been fueled by the Federal Reserve their rate cuts over the course of the year, which is providing a tailwind for an asset class that doesn't actually pay interest. On top of that, it's also the uncertainty around geopolitics and trade, which is having traders flock to a safe haven asset that gold and silver usually provides. So some of these dynamics could spill over into 2026. I've certainly spoken to a few strategists that argue that there's more runway in these companies, but it's very uncertain just given the volatility of the stocks. The last 2 days, that whipsaw that we've seen is definitely evidence of that. But today, the shine is back on gold and silver, and it's not just Aya that I'm focusing on here, or that's rallying along with TSX miners. It's also names like Silver Core Metals, Oceana Gold, Allied Gold, and many others. Lindsay.
Yeah, no kidding. Seeing quite the rally today with a lot of those companies. But when we look over at some of the energy companies, Energy Fuels, for example, dropped today. That company did see some big gains this year, though. What are you watching for there as we round out the year?
Yeah, it's a different story for Energy Fuels. That fell by 5% at its lowest point today, which is giving up some of the gains, like you mentioned, that it enjoyed so far this year. And a lot of the losses today can be pointed to a Roth Capital note where the analyst Joe Rigor said that he was maintaining his sell rating on the company, saying that the shares were overvalued. And yeah, so he also said that though the company's recently provided production and sales figures came ahead of the team's expectations, he views it as a slight negative because the company said or plans to sell 360,000 pounds of uranium in the fourth quarter. Now, Rigor estimates that could sell for around $80 to $85 a pound in Q4. But in 2026, he estimates that spot prices could reach $100. So they held off. Maybe they would gain a little bit more there. I should add that Roth Capital is currently the only analyst group that has a sell rating on the company. At least 7 other analysts have a buy rating. And also shares are still up about 160% so far this year, hitting a peak in October, coming down a little bit from there, but still triple-digit gains in 2025, Lindsay.
Yeah, still not a bad year. Okay, Stephanie Hughes from Bloomberg, thanks so much. Appreciate your time.
Thank you.
Up next, we're taking a look at precious metals and what's going on with global futures as we head into a new year. Stay with us. Precious metals have been on a roller coaster lately, but what does 2026 hold? We will break it down with Bruce Campbell, founder and portfolio manager at Stonecastle Investment Management, and he joins us live now. Good to have you. Thanks for taking the time.
Yeah, thanks for having me on, Lindsay.
So what do you make of the drop we saw yesterday, the rebound we're seeing today? Is this just kind of end of the year sell-off and reinvestment, or is it more than that?
Well, boy, it sure has been volatile, right? I mean, certainly in the short term. I mean, if you look at the year charts on gold or silver or platinum, I mean, they've been almost straight up, right? And so it's not surprising that you do see a little bit of this volatility. We've seen volatility indexes on the metals themselves move up a little bit. And then if we look at what I saw as probably the reason yesterday for the sell-off was really when you saw some of the futures exchanges increasing their margin requirements, that just meant that some of the weaker sellers or some of the weaker holders who didn't have full margin had to sell those positions off, and then they sold it out. And then today we just saw that rebound. We continue to see this really interesting situation where both in the London Metals Exchange and on the Shanghai Metals Exchange, you actually have silver in a backwardation period where the prices now are higher than where they will be in the future. And that's really showing you that there's big demand out there and there's limited supply. And so until that gets sopped up, you could certainly see the price continue to go higher. The one thing that you have to be careful about here, though, is that we really do see sentiment getting pushed to extremes when you're looking at these precious metals.
So interesting. I mean, that's the story for a couple of others too, right? Copper, where there's such a high demand, but not enough of it being produced at the moment. When it comes to silver, is that kind of the story for 2026 then? Like you mentioned, what we're seeing right now in Shanghai and in London, are we going to keep seeing, demand, but maybe not enough supply?
Yeah, I mean, obviously the thing with silver that's a little bit unique is that it's a precious metal, but it's also an industrial metal as well, and it's used in a lot of different applications. And so there's now this big demand. I mean, silver production hasn't been that strong. It still continues to be very challenging to get mines through the discovery process and into actual production. And so this could be something that, is again a headline item through 2026, especially if we see any type of industrial production numbers start to really pick up, and there's more consumption from the industrial usage as well as the precious side.
So would you stay fully invested right now? Like, do you think what we're seeing today in terms of gold and particularly silver is a real comeback or just a bounce? What do you think we're going to see before the end of the year, which I guess is tomorrow?
Yeah, I mean, that only leaves us with one day left, but who knows what that brings tomorrow. But I would suspect that the trend continues to be higher. That being said, we do see sentiment pushed really far. And so anytime that sentiment does get pushed to that extreme, you can see what happens. The littlest bit of negative news, and all of a sudden people rush for the exits as they did yesterday. So there's going to probably be some volatility with sentiment being this high. So you just have to be prepared for that. But I think, if you're a longer term investor and you're looking out, into the end of next year, then, things could continue to be fairly strong, especially for the equities, because you think about their cost of production versus their sales price now, and there's a huge difference. And they're making, that cash flow is just going to start to drop to the bottom line.
Just broadening out a little, are there certain sectors that you see that are starting to rotate?
Yeah, we are starting to see certainly some sector rotation. We saw the healthcare sector really pick up, kind of more in the fall, and continues to be strong here now. And we keep our eye on energy, even though the price of the commodity has dropped from the high in June. We continue to see that the stocks have been doing fairly well, and so we start to wonder whether or not we're going to see some really strong rotation there. We haven't seen it quite yet in some of the technical charts that we look at. But we are starting to see it individually in some of the individual stocks that we follow.
Interesting. Okay, and you do have some stock picks for the new year. We can go through some of those right now. The first one, I don't want to mispronounce it, but the ticker for it is ANRG.
Yeah, Energia is the company, and what they do is they're in the biogas area, so they make renewable natural gas from different types of waste. And if you look at this company, it IPO'd I guess 4 years ago now, and basically went straight down from there. Almost was in a position where they went out of business. They were recapitalized, and then since then, the new chairman that's come in has done an amazing job of getting new contracts and new orders for this company. And they're getting some really big orders from really big customers. So Pepsi, as an example, is one of their customers, and for their Frito-Lay division, they're using the waste that they generate from potatoes and generating power and natural gas for their facilities around the world. They've only signed a couple of those deals, but there's about 20 of those locations around the world that could be opportunities. And so this is a company that has continued to increase its backlog, continued to increase its revenue, and then just last quarter, they actually went EBITDA positive. So it's one to watch for sure.
Wow. Okay, your next pick is Rocket Doctor AI. What is this one?
Yeah, so everyone's talking about, AI and large language models, these guys have produced their own large language model specifically in the area of medicine. And so what this means is it's a finite closed system where new information is only introduced into the system by them. It's not out there pulling information from wherever. And it's used by doctors to really triage patients and get a narrower idea of what the opportunity set might be and what the ailment might be and what type of diagnostics need to be done. So they have that division, and then they also have another division which is almost like the Shopify for doctors, where it sets up doctors so that they look after all of the logistics of their business, and all the doctors have to do then is take on patients. And if we go back a few years ago, teledocs was all the rage during COVID. But one of the disadvantages of that was you couldn't see the same doctor necessarily twice in a row unless you got lucky. Well, with Rocket Doctor AI, you're able to see the same doctor online. You're also, as a doctor, you're also able to specialize. And so if you look at what's been happening, they have revenue in Canada. They have just started to produce that revenue in the US. And I expect that sometime in 2026, they're going to actually turn EBITDA positive as well.
Something we might need more of in the next couple of years as well as AI doctors. Your last pick that we'll just go through now is Kraken Robotics. Tell us more about why you like this one.
Yeah, I mean, Kraken continues to be focused on, undersea robotics. And this is the kind of the next frontier, right? I mean, everyone knows about drones and how many drones we have in the air, but we don't know that there's this big demand for drones underwater. And so Kraken has a bunch of different sonar and sensor technologies, but their real strong suit is their battery technology. Because of the pressure, there's different requirements for those batteries. And their big client is Anduril, which is the U.S. private defense company. And Kraken just continues to get more orders from them. They've got orders from other companies as well, and this is going to be a huge spending area. The stock tends to be a little bit lumpy in that, it tends to go up as there's news flow and information about it, and then it flattens out. It's been through that sort of consolidation phase, so I would think that into 2026, with any good news, it's going to start to move higher.
All right, very interesting stuff. Appreciate you joining us today. Thanks so much. Happy New Year.
Thank you so much.
That's Bruce Campbell, founder and portfolio manager at Stonecastle Investment Management. Coming up, Donald Trump hosted Israel's Prime Minister Benjamin Netanyahu for lunch at Mar-a-Lago yesterday. More on what came out of that meeting is coming up next. Welcome back. Amid concerns over a fragile ceasefire in Gaza, the U.S. president yesterday held a high-stakes meeting with Israeli Prime Minister Benjamin Netanyahu. It took place at Mar-a-Lago in Florida, and it comes as a group of Canadian activists called for sanctions after they were denied entry into the West Bank 2 weeks ago, along with half a dozen MPs. With more, here's CTV's John Benavelli-Rao.
Far from Donald Trump's meeting in Florida, in Gaza, displaced Palestinians trying to survive a harsh winter offered mixed opinions about whether the meeting might amount to much. This man saying everyone's exhausted, cold, and urging the U.S. president to get his peace deal moving on to the next stage and eventually reconstruction.
Gaza's a tough place.
Trump and Israeli Prime Minister Benjamin Netanyahu speaking with reporters, saying Gaza was among 5 major subjects to be discussed. Trump said he hoped to move to phase 2 of the ceasefire plan quickly, but adding Hamas must disarm. He also suggested the U.S. would consider further military action against Iran if the country tries to rebuild its nuclear program.
Now I hear that Iran is trying to build up again, and if they are, we're going to have to knock them down. We'll knock them down. We'll knock the hell out of them, but hopefully that's not happening. I heard Iran wants to make a deal.
Meanwhile, in Ottawa, a group of activists held a press conference after they were stopped by Israel at this border crossing 2 weeks ago, trying to enter the occupied West Bank from Jordan. Along with 6 MPs, the group, sponsored by the nonprofit the Canadian Muslim Vote, planned to observe conditions there, but was denied entry for what the Israeli Defense Ministry said were security reasons.
This denial of access is not an isolated incident. It is a small sample of the systematic control and intimidation that Palestinians face every single day under occupation.
The group noting that Israel's security cabinet recently approved the recognition of 19 new settlements in the West Bank, which Canada considers illegal under international law, and calling for sanctions on items that come from them.
Any settlement product that's developed and sold should be barred from Canada.
As for whether that Canadian delegation will try to go back to the West Bank, they said they'd like to, but aren't sure what will happen next. John Benavelli-Rouse, CTV News, Toronto.
Coming up after the break, we will take a look into Canada's housing market performance this year and the housing trends expected to drag into 2026. That's next. Warner Brothers plans to once again reject Paramount's $108 billion U.S. takeover bid next week. That's according to people familiar with the matter. The board has not made a final determination, but will be meeting next week. Paramount's bid, which is personally backed by Oracle's Larry Ellison, did not increase its financial terms. This decision could keep Warner Brothers on track to pursue the rival Netflix deal valued at more than $82 billion U.S. Copper is headed for the longest winning run since 2017. The metal's December rally is being powered by the prospect of more stress in the supply chain. Traders have been rushing metal to the U.S. in anticipation of potential tariffs, tightening the market for the rest of the world. Futures have rallied by more than 40% this year, setting up the biggest annual advance since 2009. And Frontera Energy has entered into a $120 million repayment and commercial agreement with Chevron Products. The Calgary-based company will commit to deliver a portion of its crude oil production for a period of 2 years to Chevron. Frontera said the agreement will replace an existing prepayment agreement, which expires at the end of January 2026. And shares of Meta rose today. The tech conglomerate has agreed to buy Manus in a deal valued at $2 billion US. Manus is a popular Singapore-based artificial intelligence agent that's founded in China. The transaction marks a rare U.S. acquisition of an Asian tech company. A Meta spokesperson has said there will be no continuing Chinese ownership interests, and Manus AI will discontinue its services and operations in China. This year, Canada's housing market has faced the impact of tariffs, ongoing socioeconomic challenges, and even saw a new federal leadership. But will 2026 be the reset for the housing market? For more, we were joined earlier by Philip Soper, CEO of Royal LePage.
Our research showed it was the single biggest drag on housing activity. The interest rates moved from being a barrier to entry to being either neutral or even supportive. Employment was stronger than we anticipated. Generally, economic conditions were supportive. Yet you go out to consumers, you ask them, how are you feeling and what is bothering you if you're not making major decisions like automobiles or housing. Mm-hmm. And it was trade.
And do we know a number on how much it might have dragged things down, or is it just something that we know it had an impact?
Well, if you look at what the market should have done, given the other economic drivers, we're probably looking at 2 to 4% impact on home prices. And it simply was, home prices hung in there remarkably well, even in our most expensive cities like Toronto and Vancouver, but activity levels were very low. And when you have demand at lower levels and supply healthy, you're going to see slippage in prices. And that's what we saw in our two major markets.
And what other factors were driving it? I mean, we saw a population decrease for the first time. Was that an issue as well?
Yeah, the drop in immigration, temporary foreign workers, foreign students really impacted the condominium market. and particularly in larger cities, the individual investor supplies a lot of our rental stock in big cities. When interest rates peaked, or mortgage rates peaked during the inflation spike post-pandemic, it made the math for small investors in rental stock, condominiums, just not work. They should have come back in 2024 and 2025 as interest rates declined, and they just didn't have at the rate one would have expected. And a big part of that was their clients, their tenants disappeared with the much smaller quotas on temporary Canadians or new Canadians.
Now, heading into 2026, are we going to see movement across the board, or will there be areas that may see improvement and some that will still stall, like condos?
Yeah, overall, we're seeing prices up next year by a small amount, just over flat, 1% in aggregate across the entire market. Detached homes higher than condominiums, detached homes in aggregate nationally up 2%, condominiums down 2.5% in our forecast. But very different looks in different regions of the country. We're seeing continued softening, driven predominantly by the condominium sector, but not exclusively, in Toronto and Vancouver, whereas home prices in most of the rest of the country are expected to grow modestly. What I've been seeing over the last couple of years, you could actually go back to the end of a pandemic housing boom in 2020, the beginning of 2022, is compression, where our modestly priced cities have been easing upwards in home prices, home values, whereas our two most expensive greater metropolitan areas, Greater Toronto, Greater Vancouver, have been declining. So we're seeing that huge gap that has opened up over the last decade starting to normalize somewhat.
And is this more of a balanced market? Can we call it that?
Yeah, you know what? When you don't see home prices changing at above 5%, which is the long term, 50 to 75-year norm for house price appreciation in this country, you're looking at balanced markets. And if you look at other indicators, the ratio of sales to homes listed for sale, they're in that balanced territory. In general, it's not a bad time for homeowners. They're not seeing that 5% appreciation, but they're also not seeing a material decline in the value of their homes. And if they are trading up, obviously, if there's a little bit of a difference between what their home is worth and what it was worth, that's going to show up in the home they purchase as well. The big difference is that it's a more supportive environment for younger families, for first-time home buyers. They can add conditions into a deal, and home prices are softer, both in suburban and urban areas of our most costly cities.
And we're almost out of time, but I just want to ask quickly, the government, there was a lot of talk with the new government about homes and helping in that. What do you see happening over the next year when it comes to the government involvement?
It needs to be multi-level. It needs to be municipal, provincial, and federal. All levels of government in most regions of the country are saying the right things. The new federal government's policies are supportive and thoughtfully integrated across all the elements that drive housing. The proof will be in execution. Okay. Can we move policy ideas into actual shovels in the ground, increasing supply and providing that affordability lift for young families?
That was Philip Soper, CEO of Royal LePage. Well, the end of 2025 means the end of an era. Berkshire Hathaway CEO Warren Buffett is set to retire at the end of the year. So coming up, we'll take a look at what comes next for his legendary firm. Legendary investor and Berkshire Hathaway CEO Warren Buffett is retiring at the end of this year. Here's how the Oracle of Omaha changed investing forever and what's next for the company he built. This Bloomberg doc dove deeper.
If investors had a Hall of Fame, Warren Buffett would occupy his own wing.
People from all over the planet look up to him, read his biography, hop on a plane to go see him talk.
He took a failing textile mill and turned it into $1 trillion conglomerate. It has insurance companies, Dairy Queen, railroads, and energy businesses.
For decades, Buffett's investment savvy has led Berkshire Hathaway to beat benchmarks.
One of the biggest asset managers today, which is Vanguard, the entire philosophy is no one's really going to be able to beat the market, so you might as well not even try. Well, okay, no one besides Warren Buffett.
If you look at the total returns, Berkshire blows the S&P 500 away.
The legendary investor Warren Buffett.
So when the 95-year-old announced he would retire at the end of 2025,
Greg should become the chief executive officer of the company.
It marked the end of an era at Berkshire Hathaway and left everyone with one massive question. Warren Buffett is one of the richest people on Earth, but his lifestyle doesn't exactly scream it.
He lives in Omaha. He lives in the same house he's lived for many, many years.
Holiday sausage muffin with...
He goes to McDonald's in Omaha. A lot of people around the city know him.
He's paid just $100K and has been paid that amount for years. That's very refreshing when you think about the landscape today.
So what's the backstory? Well, Buffett's childhood fascination with money led him to Columbia Business School, where he studied under a renowned educator.
Benjamin Graham was a financial analyst considered to be the father of value investing.
Value investing is really this idea that you're not just betting on some fluke in the market. You're really looking at what you think it's worth versus what the value that the market is providing. Ideally, you want to buy a company that you think is undervalued and that it's going to rise in many years. But that requires a lot of due diligence. That requires you to make sure you actually understand how the business works.
I'm not buying them because I think they're going to go up next year. I'm buying them because I think they'll be worth quite a bit more money 10 years or 20 years from now.
Investment after investment, that strategy came to define Berkshire Hathaway. But let's see it in action by focusing on just one.
American Express is an investment that he's had for decades, and when he bought it, the stock price was a bit down because of a scandal at the time, but he saw the value of Americans that kept swiping those Amex all over the place.
That was back in the 1960s. But look at this. Berkshire's current Amex holding was largely assembled here in the 1990s for about $1.3 billion. Since then, Buffett's largely left that core stake intact. But Amex's market value has soared in the years since, making his 22% holding worth tens of billions of dollars.
He was interested because the company has a good moat. By moat, he means some competitive advantage against other companies in the business.
For Amex, that moat is a mix of its premium brand, affluent cardholders, and a network built around their spending power.
Another kind of edge you can have over your competitors is regulation.
Think about the energy business. A lot of those have advantages that a competitor couldn't come in and easily take the market share. That's really helped his business sustain itself. He's built up companies that are not so easy to replicate.
But perhaps the most underappreciated force behind Berkshire's rise is its insurance business.
They're not always the companies that are going to draw the hype from stockholders, but it's actually been a force that's built up Berkshire a lot.
The insurance business provides us with float, and float is money that we hold that doesn't belong to us.
The way it works is it has a very large insurance arm that has a lot of money from policyholders. They have to invest it to reap some benefits and make sure that they can pay claims afterwards. Berkshire Hathaway has been ramping that up to the max, buying a lot of insurance companies and using that money, the float, to invest afterwards.
This is actually one of the hottest plays in the investment world right now, with a lot of private equity and alternative asset managers either buying or having relationships with insurers.
While Buffett has been the face of Berkshire Hathaway, he long had a sidekick. both conveniently available as lovingly hand-rendered plushies.
Charlie Munger passed away in 2023, but the dynamic he had with Buffett for many years was one of the main draws of Berkshire. They were a unique pair. If you saw them sitting together at the Berkshire annual meeting, they would banter.
I predict Charlie's going to talk about Costco. Go ahead, Charlie.
Well, Costco, of course, is a...
Munger was fundamental to Buffett's investing thesis. At the start of his career, Buffett was very into this idea of cigar butt investing, in which you would take a company, you'd take one last puff, and you'd get what you could out of it before it sort of faltered. And Charlie was one who really reshaped his thinking into thinking about companies that had a longer-term advantage.
He went from buying companies that were, not very famous, like Berkshire Hathaway, a textile mill that was struggling, to taking stakes into Coca-Cola or Bank of America.
Not that this approach is always a sure thing.
One is IBM, when he bought a stake in the early 2010. He said afterwards that it was a big mistake. He didn't see how IBM was about to lose the turn of the industry towards cloud computing.
He also orchestrated the merger of Kraft and Heinz about 10 years ago.
It just hasn't gone to plan. Part of that is down to changing consumer tastes, consumers wanting healthier things. Part of that is down to inflation. And Buffett commented recently that while he didn't think the merger in hindsight was a great idea, he doesn't think that undoing it is going to fix the company's problems.
And lately, Buffett has struggled finding companies he wants to invest in, leaving Berkshire with a record amount of cash.
It is so much easier to make very successful bets when you're managing 100 million, 200 million. He's now got a cash pile that's more than $300 billion.
And finding a place to put that capital to work is getting really difficult. He doesn't like to have money that is sitting around and not earning more money.
Higher interest rates these past few years have turned that cash pile into a nice income generator.
But it is going to get harder and harder to deploy that level of capital the bigger it gets.
So this is the Berkshire Hathaway Greg Abel is inheriting as the company's new CEO. Although sadly, we don't have a plushie of him.
He led Berkshire's energy business for so many years. But it is tricky. Warren Buffett has not only been a very good investor, but he's also pretty charismatic. That's part of the reason that so many investors have always made that trek to Omaha despite the cost, despite the distance.
Abel will also be taking charge at a time when Buffett's hallmark strategy is being tested.
It is tough to be a value investor when what's really lifting the stock market is high-growth companies. The tech company's valuation might be really high compared to sort of what the underlying assets are. While Buffett has bet on technology in recent years, his misses on those opportunities will always sort of linger.
The change in leadership also risks reviving a long-standing debate.
A conglomerate is not a thing that has stuck around. We've seen many conglomerates, such as GE, fall apart in recent years and sort of be split up.
Buffett's presence at Berkshire won't be disappearing overnight.
He'll remain as chairman, and I think his influence will still be felt by the company. He's a major shareholder of the firm, and while he's slowly divesting that stake and giving it to his children's foundations, I think his legacy will long be felt.
But Abel will be taking over many of his duties, including the writing of Berkshire's annual letter to shareholders.
This is a big change because Buffett fans have been poring over that letter over the years because it's full of witticisms, investment advice, pearls of wisdom. There's also the fact that he's not going to be taking Q&A at the annual meeting next May in Omaha.
Morning. Welcome to Berkshire Hathaway.
He was talking for 4 to 5 hours every year and taking questions from people that follow him all over the planet. That is going to be a big change because Buffett's personality is unmatched in the investment world.
Coming up, it is Hot Picks. We'll zero in on 3 plays in software, including sticking to the classics with one of the Meg 7s. More on that when we come back. Okay, let's dive into some stocks now that have been on investors' radars. We were joined earlier with Rishi Jaluria, Software Managing Director at RBC Capital Markets. He discussed his hot picks in the software sector, and we kick things off with Microsoft. Take a listen.
That's been proven to be able to reinvent themselves time and time again. Obviously they were, as you mentioned, a pioneer in software, but they really successfully navigated the cloud transition incredibly well. If you look at the momentum they had with Office 365, with Azure, with everything in their cloud suite. And now they're going through that again with AI, right? They were very early to AI, making the first investment in OpenAI back in 2019. And look, they're going down an AI first route, infusing AI throughout the stack. And what I think really impresses me the most about Microsoft, or what makes me the most optimistic about this name, is the fact that I think they have the most amount of ways of benefiting from AI throughout the stack. It's not purely just using the raw compute capacity for training of models, but it's at the data layer with things like Fabric and Cosmos DB. It's at the developer layer with GitHub Copilot, at the application layer with Office Copilot, security layer with Security Copilot. We can even imagine properties like LinkedIn and gaming that are overlooked by investors today becoming material beneficiaries of AI.
So Microsoft, as big as it is, still seems to be able to adapt and lead.
I think that's right, and a lot of it definitely comes down to the leadership of Satya Nadella, who's been very forward-thinking throughout his tenure as Microsoft CEO.
What's he done the most that's impressed you?
I think the biggest thing that I think he's done that I've seen is really double down on innovation, right? The larger a company gets, the harder it is to actually innovate, to come up with new ideas. But he's created this culture of innovation, of almost having a more open ecosystem, a kinder, gentler Microsoft, so to speak, versus what we saw under the Steve Ballmer era, that Microsoft is willing to work directly and integrate directly with their competitors. And I think anything that breeds customer success breeds innovation, and that ultimately breeds company success. And I think that culture that Satya has created has allowed them to be so successful.
Okay, next up, MongoDB.
So MongoDB may not be a household name, but they're a next-gen database vendor. They compete with Oracle, but they're really focused on unstructured data. Think about data that can't fit neatly into rows and columns. And look, the stock's had a great run off the bottom. But what I think makes me the most excited about this one is really, if we think about the opportunity for the creation and development of net new AI applications, especially those leveraging this unstructured data, MongoDB is really well positioned, has the right technology, and I think this can be that developer platform of choice for those AI applications. We're already seeing some of these very hot AI natives like Cursor and Relevance AI using MongoDB, and as those companies become more material, I think that becomes a real tailwind for Mongo.
And what are some of the technologies that you like that they're incorporating?
Yeah, look, I think there's a couple things. Number one is just the ability to work with unstructured data, because working with unstructured data is a very fundamentally different problem than working with structured data, which is where you'd use something like Oracle or open source Postgres. But then I think it's also integrating a lot of these adjacent technologies. You think about things like bringing an Atlas search, a vector database with MongoDB Atlas Vector. Now they're leveraging AI to make it easier to move relational workloads onto a non-relational database, in this case, MongoDB. So I think it's really bringing in all these adjacent technologies onto this core non-relational database and expanding that, because that just leads to greater share of wallet, greater share of workloads. And I think, again, puts them in that position that as we see the development of more and more AI applications, and those applications get scaled, that becomes a real tailwind for MongoDB.
Okay, and last up is HubSpot. What are you liking about that?
Yeah, so HubSpot is, I think, a really compelling company. I almost think about them as the anti-Salesforce. They're in the same spaces as Salesforce. You think about sales, service, marketing, commerce, operations, et cetera. But in contrast to Salesforce, HubSpot is a company that has been built from the ground up organically. So all those different modules that we've talked about are built on the same platform versus through a string of M&A, which is what we see out of Salesforce. And I think this is, again, a company that is really investing in innovation, in customer success. And I see two ways that HubSpot can be a major beneficiary of AI. Number one is I think they have one of the most forward-leaning AI roadmaps in front office application software today. And really that comes down to their co-founder and CTO, Dharmesh Shah, who is probably more hands-on with AI than any public company exec, at least in this market cap range that I've seen. But I think the second thing is I believe they can leverage the innovation that AI brings and accelerate the pace of product development and use this as a way to narrow the gap versus Salesforce, because Salesforce definitely competes in the large enterprise. Just think about the Global 2000, whereas HubSpot tends to be more in the mid-market. Over time, I think that will change, right? If they can use AI on the product development side, create those governance and security and customization capabilities that are necessary, I wouldn't be surprised if we see HubSpot win a deal in the Global 2000 against Salesforce in the next 5 years.
That was Rishi Jaluria, Software Managing Director at RBC Capital Markets. Well, Canada's sovereignty has faced some pressure during U.S. President Trump's second term so far, leading Prime Minister Mark Carney to prioritize military investment this year. CTV's Judy Trinh has more in this report.
Canada's new government will rebuild, reinvest, and rearm the Canadian Armed Forces.
The Prime Minister's clarion call to defend against a superpower's imperialism.
What I'd like to see, Canada become our 51st state. We give them protection, military protection.
Donald Trump turned his threats into a trade war, pushing Mark Carney to turn the military into an economic shield.
I'm announcing today that Canada will achieve NATO's 2% of GDP target this year, half a decade ahead of schedule.
Carney's first budget invests nearly $82 billion in defense over the next 5 years. There's more money for recruiting, training, and equipment. Soldiers are getting raises and bonuses for serving overseas and deploying in the far north.
The priority is the defense of Canada and the Arctic. So we are investing both in terms of capabilities, but also in terms of planning and programming.
Climate change has made Canada's Arctic and its natural resources vulnerable to foreign intrusion by Russia and China. Better weapons are needed to patrol from the land, sea, and air. In the past, 75% of procurement dollars went to American companies. That's being reduced.
We're not going to be spending 75 cents of our dollar south. We'll be amortizing that money out in Canada where we can, and then spending it in other places where we have to.
The Defense Investment Agency, created in October, aims to ensure that Canadian companies benefit from big procurements, like the plan to replace a fleet of aging submarines. The Navy wants 12 conventional subs.
The reason we need submarines is very simple. It's the only technology in the Navy that guarantees that we control our waters. That's the first one in Canada.
There are two competing bids. The Prime Minister visited TKMS, the German-Norwegian conglomerate, in the summer. Then in the fall, Carney visited the South Korean rival, submerging himself in Hanwha's proposal.
I'll be back in 60 days.
The contract, which includes manufacturing and maintenance, could be worth more than $100 billion. The winning bidder is expected to share the rewards.
Buying Canadian, both in terms of steel and aluminum. So that's not a surprise. I think for both submarine manufacturers, they would be looking at that. Obviously, the question of servicing these vessels over time. I mean, remember, this is a long-term investment. We're talking 30, 40, maybe even 50 years.
While the submarine supplier will be chosen next year, the decision on fighter jets is still up in the air. Canada has already purchased 16 F-35s from the U.S. With Trump's tariffs, whether to buy more is being reviewed.
I don't believe that we've had enough jobs created and industrial benefits done out of the F-35.
Then there's the Swedish charm offensive. The king leading the charge to pitch the Gripen fighter and offering to build the Nordic jet in Canada.
The government's steps to diversify our defense and trading relationships are absolutely crucial, but need to be accelerated.
The military budget will continue to increase over the next decade. The Prime Minister, along with NATO allies, has committed to spending 5% of GDP on defense by 2035. That will equate to roughly $150 billion a year, the cost of defending Canada's sovereignty. Judy Trinh, CTV News, Ottawa.
Know Your Options is back. You can tune in tomorrow at 3 p.m. Eastern Time to have all of your options trading questions answered by Chris Tom of Moat Financial. You can email us your questions at knowyouroptions@bnnbloomberg.ca. Thanks for joining us today on The Close. We will see you tomorrow.